Today, we're going to get into the 3 things you need to consider when you're making investments and diversifying your portfolio. Again, nothing here is financial advice, only for entertainment and educational purposes only. Always consult with your financial advisor before making any investment decisions. So what are they? What are the 3 things you need to look at every single time you're making an investment or thinking through your investment strategy? Not every investment has to meet all 3 criteria, but your portfolio of investments should be structured in a way that it's balanced and your concerns and your main interest, and you may have one over the other in this basket of 3, but there are always 3 considerations, should be represented, right? So maybe as you get later in life, you might not be as concerned with generating your wealth. You may have already established that. Families I work with are a lot more cognizant of maintaining their wealth long-term, so they will take less risky investments. Their allocations to digital assets in a lot of instances are far less, but the asymmetric bet there could have a significant return. So very little downside, a lot of upside. And that all plays in. 1, ROI, return on investment. What am I going to get from making this investment? And the caveat here, and the real thing you need to consider is this going to outpace inflation? You need a real return on the investments you're making. Why would this be a large consideration? Well, a lot of people, you might sit your money in a bank account and you might have some type of return there, with interest rates where they're at right now. You could be generating, there's some accounts where you're getting close to 5% returns. Is that a real return with where inflation is? No. Inflation's still far above that mark. We have had the Fed raise rates in order to combat that, but we're still seeing, if you're looking at real prices of assets and food and gas and other things, they have come down. However, the inflation rate is still, I would say, above 5%. So you need to put your capital to work somewhere that's generating in the neighborhood at least 8% on an annual basis to make sure that you're maintaining your wealth and your purchasing power over time. And that's been very difficult to do the last few years, since 2020 and the erratic movements we've seen in the market. We've had huge volatility upward and downward, while inflation has been moving aggressively higher, right? So the people that have done well, they were in assets that appreciated during that period of time. 2020, we saw 20+% in the stock market. Real estate was the same way. People complain that the rich get richer. Well, it's because they own assets. And if you understand how that works, then you can position yourself the same way. You want to make sure that when you're investing, you're looking at things that are going to outpace inflation in their appreciation over the time frame that you're going to own that investment, and that you're going to generate, again, a real return on your money. Number 2, is this investment going to create cash flow or be a part of my portfolio that creates cash flow and passive income? And so that could be dividend paying stocks. If it is crypto, maybe it's staking rewards or a liquidity pool, or, if you're in other types of annuities, money markets, things that are going to pay you, monthly, quarterly, annual cash flow to support your lifestyle, your living, and potentially replace your active income, right? I know that's, everybody's dream. You want to make sure that your bills are covered, your expenses are covered, and you have excess. My definition of financially free, you are generating 2 times the amount of your expenses every single month from passive income. If you're doing that, you have to have assets or investments that are producing cash flow of some kind. Again, doesn't matter the cadence, as long as you're responsible with those dividend payments or the income, and you're able to allocate that accordingly and live your lifestyle. So always a consideration. And then if you are generating cash flow, and that could be purchasing a business, it could be real estate properties, and there's a lot of different ways to do it, whatever your preference is, and you really need to understand what you're investing in. I always recommend doing due diligence and having maybe a mentor that can help you with these things. But wherever your preferences lie, you're going to make those investments, make that a core part of your portfolio or investment strategy, and then to be able to generate the cash flow from that over a period of time to remove your active income. And then you can take those cash flows or whatever the excess is and continue to make investments. On the topic of real estate, I will say that that's probably the one that meets all 3 of these that people are familiar with. So in most markets, you're going to get appreciation on your real estate. At least that's been true over the last 20 years for sure. Obviously, there are periods where there's boom and bust cycles and things become overheated or inflated, and they do regress. We saw that in 2008. Different types of real estate and different markets are going to have different cycles. Again, you really need to partner with somebody that understands this if you're investing in that realm, or you need to have the understanding yourself. But it's going to generally keep up with inflation or do better than inflation. You're going to have rental income off those properties. And then last, number 3, can I take leverage against this asset? How liquid is the asset? If I want to sell, what does that look like? If I don't want to sell, can I borrow against it to maintain exposure and then be able to repurpose that liquidity somewhere else to capitalize on an opportunity? Let's say you purchase a home, a multifamily property, a commercial property, even raw land, and there's appreciation on that. And maybe you do have a mortgage or a loan against the property that you're paying on that you use to acquire it. But the equity piece, appreciation in there, you should be able to draw that line of credit against that in a HELOC or another loan from another institution fairly easily. And that's why people favor real estate, is it's a hard, tangible asset that you can easily, draw a line of credit against and then redeploy that liquidity somewhere else. Nice to have. It tends to be low risk for the banks or the other people that are loaning against it. It tends to be a favorable interest rate. And that's always a consideration when you're making an investment. That's why you see a lot of family offices or high net worth individuals or maybe even RIAs don't play in the private equity space as often, because those investments tend to be illiquid for an extended period of time, and there really is no meaningful way to draw lines of credit against them or pull your liquidity back out of those and diversify or hedge against the risk that might be associated there without deploying other components of your investments to offset that, right? So, and the thing I will say is you always want to be responsible when you're taking a line of credit against an asset. Generally, it's hard to even put a qualifier on this, but I would say, maybe 50% is kind of normally what I look at when I'm drawing against something. I wouldn't do more than that, especially if it is volatile, if it's crypto. In Digital Ascension Group, we work with individuals to help them get lines of credit against their digital assets held in qualified custody. That's a very volatile market, so maybe even 30% LTV would probably be a better way to go about it. And for LTV, that's loan to value, is what that acronym stands for. And again, interest rates are always a consideration. So wherever you're taking that loan at, whatever interest rate, you want to be repurposing that capital somewhere else. It's going to generate a higher interest rate. Otherwise, why are you doing it? Maybe you are taking the loan here at a low LTV, and then you're going to purchase a more traditional asset that is more stable than digital assets to hedge against that. That's often our strategy. And this is the other piece. A lot of people look at tier 1 collateral like Treasury bonds. Warren Buffett has a large amount of his liquid capital sitting in Treasury bonds, generating whatever the interest rates are right now, somewhere between 2 and 5%, depending on where you're at, short-term versus long-term Treasury bonds. And there's plays there on how to structure that. But you're liquid, you're able to, take that collateral. It's premium collateral. It's riskless in the eyes of the bank. And so you could leverage lines of credit against it. It's cash flowing and it's solid. It's not going to keep up with inflation, but it's a good place to park capital when it's not deployed and you don't have an opportunity for it. Here's the 3 considerations. When you're looking at an investment or structuring your portfolio, again, 1, you're going to be looking at ROI. Are we going to beat inflation? Can we make sure that we're going to maintain our wealth over an extended period of time and grow our wealth over an extended period of time? 2, are we generating some type of cash flow to supplement our income and then be able to redeploy that capital back into investments or our lifestyle? And then the third component, again, is your ability to leverage a line of credit against that asset or the liquidity of the asset itself. If you are just getting into investing or you're looking to structure your portfolio with your investment advisor, make sure you're having these conversations. So to close out, if you haven't yet, please like, subscribe, and we'll see you on the next one.